Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Tightening the Screws on Aussie Households with our special guest and friend of the show, Martin North. After the last 16 months of interest rate increases from the RBA, it finally looks like they might be on pause for the foreseeable future. Does that mean renters and mortgage holders across the country can breathe a collective sigh of relief? Walk the World host and digital finance analytics founder Martin North's recent research suggests not. Join us today as we find out who's suffering, who's okay, and who might have more pain to come. Just a quick reminder, this podcast is general advice only and is not intended to take into account your personal situation. If you do want to discuss your personal financial situation and how to improve that, you can book a call with me or one of the advice team at nucleuswealth.com/contact. We are normally live every Thursday at 12:30 Australian Eastern Standard Time, but today is a pre-record as Martin is in the UK. So we won't be having any live questions today, but normally you can ask questions during the show. So in the future, jump onto the Nucleus Wealth YouTube channel and ask any questions that come to mind. We are also available on all other major podcast platforms, so have a listen over there if you prefer. So without further ado, I'll hand over to Damien to lead us away.
Go ahead.
So yeah, look, I just wanted to say thanks, Martin, for coming on again. It's been a little while since we've talked, and I've got this. I think in last time we spoke, we've been certainly on our show. We speak on your show every month, but the idea of having a look at cohorts of the Australian economy, and the idea that we really haven't seen as much in terms of the way of bad debts and stress, I guess, across the economy as a whole. But whether what we're seeing is part of the economy that's fine, part that's starting to struggle a little bit, and then another part that's really starting to have problems. I guess that's where I'm trying to dig into and see where we're at, and this idea that these long and variable monetary policy lags are eventually going to hit. And I guess the other part is that I do think a lot of people don't do heaps of financial planning, and sort of basically when the credit card's full or the bank account runs out, that's when they stop spending. And I guess that's where I wanted to sort of dig into some of your data and see what you're seeing on that front.
Yeah, well, this is quite interesting. And, I often say, as you've probably heard me say before, you need to go granular, Damien, to really understand what's going on. And, some of the macro conversations, house prices have gone up X or down X, or, regional have done this and that. It doesn't really get to the heart of the matter, right? Because, of course, different people have different exposures. And just at the top level, of course, you understand that we've got about a third of the households who own a property outright, and quite a few of them are sitting on considerable buffers. You've got
a lot of those got cash as well, so they're better off with higher interest rates.
Well, exactly, and of course they're still sitting on that government handouts that happened through the COVID cycle, and some of those, of course, are in jobs that are actually still paying very well and have got big pay rises too. So you've got a third of the population, right, who's actually doing quite well. You've got another third of the population who's sitting in the mortgage bucket. So they've got a property, but they're effectively quite significantly leveraged up. And some of those, of course, are now struggling. And I think everybody understands the mortgage cliff, and people are questioning, is it a cliff or is it a sort of a slow glide? And we might explore that, because, of course, some people got interest rates at 2% or better, and it was 3 or 5 years, but when they're resetting, unfortunately they're resetting at quite a high number. And CanStar put out some information quite recently just showing the jump up. So if you've actually got a 2% mortgage, you're now seeing your repayments moving up dramatically, and in some cases the repayments are now 100% more than they were. So that's a problem. And then you've got the third of the population who are in the rental sector. And it's the rental sector that we'll see in the data as we go through it. They're the ones right on the precipice at the moment. So a lot of people in the rental sector are people who have never had a property, have no chance of getting into a property. And of course, quite a few of those in the rental sector have recently had huge amounts of expense in terms of rents have gone up. And when they try to move, it's very hard because, of course, there's a huge migration thrust at the moment. So there's more people coming into the country, and most people, when they come into the country, they go into the migration. When they migrate, they go into the rental sector. So you've got this issue at the moment that in the rental sector, it's really hot. So, I mean, at a top level, that's what you see. But then if you come down a level and say, well, let's look at the particular cohorts, from first-time buyers through to older households, the dynamics are really, again, quite different. So I think asking the question about granularity is deadly is the right question. And by the way, also regional areas versus close into the city happening very differently. So while there have been some price rises, for example, in Sydney and in some cases in Melbourne, if you go into the regions, prices are still falling in a lot of the regional areas. And so again, you need to go granular to see some of these things too.
Yeah. Okay. So let's do the country versus city then. So COVID happened. There was as we're sort of coming out of it, there was a big sort of change where people were starting to move into regional areas. Not a lot of supply. And so then we saw this sort of building wave come through. I guess is that what you think's doing it, or do you think there's some sort of, I mean, we've obviously got a big sort of hard to see, isn't it? Because there's this rising tide of immigration sort of pushing everything up. And the question is, at the margin, is there sort of less immigration in the regional areas, I'm guessing, and more in the, is that what's sort of seeing prices fall there?
Yeah. So if you look at what's happening in the regions, and again, not all regions behaving the same way, but I know, for example, Illawarra really well because I lived there for quite some time, and we had a huge rush out of the city through COVID into the Illawarra, and we saw prices at Austin, for example, going up 35-40% in 12 months. Right?
Yeah.
Remarkable rise. And a lot of those people were people who wanted to get out of the city, wanted more space, wanted to enjoy the freer atmosphere and easier to move around during COVID. So we had a significant rise there, and a lot of that was actually houses rather than apartments. Apartments didn't go the same way, and in some of those regional areas, if I take Austin Mere as an example, there aren't that many apartments. There are some, but not that many. So if you look down towards Wollongong, more apartments. If you go down the other side of Wollongong to Shell Harbour and places like that, again, property prices were moving up, not quite as fast, but there was a lot of new construction that actually people swept up as well. So that's what happened. Then it all turned back because prices eased back into some of the more central areas around the CBD and around Sydney, as if I take that as an example. And so people then said, well, hang on a moment, do I need to, I want to stay here? And we saw a bit of a drift back. So what we've now got is we've got a little bit of a movement up from people looking again at some of the prices in the region around Illawarra, say, and say, well, actually, they've dropped now 15, 18, 20%. So they're a bit more interested again. But that's the sort of the escalator up escalator. There isn't huge amounts of migration. So we're not seeing a lot of first generation people coming directly into the Illawarra. Okay. It tends to be people coming into the on migration. They look at the major centres, or they go into areas. If you think of Melbourne, for example, there are areas in and around Melbourne where there's a very high proportion of Indians or whatever who've come in and bought there. I guess Point Cook would be an example of that. And so a lot of people go there when they migrate and try and rent there. And what you'll see in some of the data is that you've got, therefore, a lot of first-generation migrants who are in the rental sector struggling now to find anywhere, and then struggling to make those payments as the rents have gone up. So I think that's the sort of the dynamic that we're seeing.
Yeah, and I guess that's the issue as well. Is that people who have just come have obviously uh, don't have as much bargaining power in terms of jobs. Even if they have a job, it's not the type of thing they can turn up and say, I've been here for 5 years, or I know I can get jobs elsewhere, and so I'm demanding a 5 or 10% pay rise. They're more likely to be the ones sort of who are in sort of the lower paying jobs, and I guess as well that's who they're competing with in the other third, isn't it? Where you're saying, okay, the people who are say in hospitality jobs or service sector jobs or retail jobs that aren't, we haven't got a lot of bargaining power. And that's, you're probably competing quite hard with a lot of the students and migrants in terms of jobs, and so you're not seeing pay rises on one side, so competing on your job side and not getting the pay rise, and on the other side competing on housing and having to push rents up.
Well, that's right. And of course, the ABS data that came out recently showed that the number of people working multiple jobs continues to rise, right? Because if you think about it, what can you do if you've got cost of living pressures? Well, you can try and work more hours, work more overtime. But a lot of people work part-time jobs. So one of the things that we saw was a considerable rise in the part-time workers, particularly women, who are actually now working more jobs. And there was significant growth in the healthcare and caring sectors, which are relatively low paid. So some of the extra activity may not generate a huge amount of additional income, but people are quite desperate, and from my definitions of stress, I talk about money in, money out, how much is coming in each month, how much is going out each month. And we're seeing more and more people now struggling with that balance, that more money is going out, particularly if they've got high rents or if they've got mortgages. And so they're really struggling with how to square the circle. I think I would just mention briefly, you've got another thing, you heard FOMO previously, fear of missing out. Well, we've now got what I call fear, as in caught in the headlights. So a lot of people don't know what to do. Should they buy now on the principle that maybe prices will go up later again? Or should they not, because interest rates might be going up? If you're in the rental sector, do you try and negotiate a longer term rent where you are, or do you try and find something else? If you're a property investor and you've done the numbers on your property investment, quite often people are now finding that some of those properties are not actually economic to manage. But there's a lot of uncertainty in the whole system, and therefore a lot of people are caught in the headlights. They're not sure which way to jump and what to do. And that's something which wasn't around so much a year, 18 months ago. And that's another factor to bear in mind here as well. There's a lot of uncertainty as well.
Well, if the RBA governor can't tell you where interest rates are going, then who can? Yeah.
Well, it makes a very interesting observation. And of course, let's overlay the energy prices, which are rising again. So the latest oil numbers are not very good in terms of, they're moving up quite fast.
Well, and it's almost worth separating those two, isn't it? There's this inexorable grind higher of energy prices in terms of heating and electricity, and then or gas and electricity, versus the oil, where we had a spike and then we had a little bit of a respite, and it's all coming back again now.
Yeah, the oil, I think, is quite concerning, because, of course, now there are reports of a net deficit of supply over the coming period, and of course we've had a couple of the major OPEC members dialing back their production. Now, of course, people are arguing, well, if prices go higher, then will they ramp up production? Well, they might. We also, of course, have got the strike in Western Australia with regard to the gas producers. And that's had a significant impact on the spot price of natural gas as well. So there's another factor in there that people weren't necessarily expecting. And I've got a theory that we've probably seen the easy ride down in terms of the inflation number, as the base effects from a year ago, which were high, fell out. But now we've got new factors coming in which could push up the base inflation. And now if that happens, then the RBA may have to lift rates higher. They probably don't want to, but they might have to, because they keep saying inflation is the thing we have to thwart. So,
Yep. Yes. Okay, do you want to jump into some of the data? Have you got some
okay. So let me just, by way of background, just for people who may not know, we do this continuous survey, and it's a rolling survey. It's 52,000 households, and those households are, sampled on a weekly basis, and then each month we produce data. And sorry, let me just make one quick change, because I can then show you what I'm seeing. Right, there you go. Okay, so this is the way the model works, and the model basically is including the sampling from households as well as all the other data that's there, right? So I include migration data and demand data as well. Okay, now I want to just talk about the definition of stress that we use, because it's really important, because there are so many definitions out there, and it's worth just underscoring that the 30% of income, which is the one that's quite often used, is probably not that helpful, particularly now. Other people use taxable income or pre-tax income as 30%, so it's not clear. That other people use more closer to the bank's underwriting metrics. For example, Roy Morgan, when they use their stress number, they use the underwriting metric as a mechanism. But we just look at it as cash flow, money in, money out. And what that means is, if households have more outgoings, and I exclude one-off discretionary items than income, then we define them as stressed. If they have the mortgage, they're in mortgage stress. If renting, they're in rental stress. So it's a cash flow measure. And that means we can look at also investors as well. For example, if they're stressed investors because they've got cash flow pressures. And we can also aggregate it to look at total financial stress, which is an aggregate at the total level. And that means we can look at it then as a proportion of households in a particular postcode, or a count. Now, I have a theory that the count is a better measure, because the count effectively gives you a view more of where the big numbers are. So you could have a household count which is very low with a high percentage, and it might not be that significant or material. But if you've got a large number of people in a particular area, then we have a problem, right? And so that's why I think this is quite an important way of thinking about it. And generally, I look at counts rather than actually percentages, right? So that's how we do it. Now, this is the top line story. So this is as at the end of August. And I'm just going to start with rental stress, because you can see there the trend up is pretty remarkable. If you go back to, before COVID and, back to 2009, we were looking at a relatively small proportion, 13, 15, 18%. But we're now up at 70% of those with a rent, 70% who are struggling, 70.54 actually. That's as high as it's ever been.
The next sort of spike, so spiked, flattened, and then spiked again. What's the start of that? What's the date where?
So this was 2009 here. So this is basically
Oh, sorry, no, I'm actually talking about the most recent. Recent spike.
Okay,
so got like this little flat section, and then
well, let me overlay this one. So this is the yellow is actually the mortgage stress, and you can see there that in February 2020, right, that was where before COVID, right? So we were 32% of those in mortgage stress. And then we had a bit of a run up. And what's interesting, if you go back long term, we had a pretty strong correlation between mortgage stress and rental stress, right? And then we had mortgage stress driving up faster than rental stress. And that was because in some cases rents went backwards through COVID and after COVID, right? And then, but suddenly in the last year or so, it's accelerated away. Now, there are three things that have happened. The first is migration started to ramp up dramatically, right? Which is why the rental stress went up. Secondly, we had significant rises in new rents. In some cases, the rentals were going up 20% plus. And thirdly, we had the interest rate rises starting to come through as well, which was having a sort of knock-on effect, particularly amongst investors. And so quite a few investors needed to put the rent up to be able to try and cover the incremental costs from the rate rises that happened through 2022 and 2023. So those factors together, are explaining what's going on, right? So that's why the rental stress is so high. Never seen it as high as it is now. That's a cash flow measure, right? So what it means is that people will prioritize their rental payments and their mortgage payments, but in so doing, they're actually putting themselves under quite a lot of pressure. Right?
Yep. Yeah. Sorry, but I'm still this. So that blue line, like it's got a really sharp spike up right at the end there,
Yes.
and then a really sharp spike up in 2021/22.
Correct.
And then the flattening part, though.
Yeah.
So that's the part
Yeah.
I'm like, what's
So what was happening there was people were able to switch to cheaper rental accommodation.
right?
Right. So when rent started to take up, what we found was that quite a few people then said, well, hang on, I need to go somewhere cheaper. So they looked further out, and they looked for places where they could
flatmate in.
Yeah, that's right. Or a unit rather than a house, all those sorts of things. And there was some of that. But then in recent times, again, with higher migration and these higher interest rates, now we've got this really significant peak up that's happened literally in the last few months.
Yeah. Okay. And that is the last couple of months. Is the last that extra after the little flat bit at the end.
Yeah. So basically, it's from March onwards. So from March this year onwards. So we certainly have seen a significant spike up, and the story, of course, is varied, because in some cases people have left the rental accommodation, gone back to live with parents. We're seeing quite a lot of that. We're seeing people getting an extra flatmate. So if you look at the count of people in a particular property, that's gone up quite high in some of the rental areas. And then you've got this other factor where people have switched from one type of property to another type of property, or moved into an area which is maybe less salubrious, or have to travel further to try and find anything. But there's an area of desperation in the rental sector. And then, of course, overlaid, as we said, we've got migration over the top. Now, the other factor, just to sort of overlay, this is the RBA data relating to the household debt to income ratio, right? And so it's at 187.5. Now, they keep restating it because, of course, it depends a little bit on what the ABS does and the RBA does it. But this is misleading, because what it basically says is, 1.8 times debt to income ratio, but that's all households. That's all households, not just those with a mortgage, right? So you really should be multiplying it by 3, one third, to give you a better indication of what's really going on. So you've got 5 or 6 times debt to income ratio. And we know that a number of new borrowers over the last few years, particularly after COVID, when all the lending standards were released and everybody sort of piled in, and we had Home Builder, a lot of people were 6, 7, 8, 9 times in terms of debt to income ratio. So recent borrowers, Home Builder connection, right? So that's one of the reasons why it's gone up. And even the RBA is saying, well, the debt to income ratio is higher than it used to be. But it doesn't necessarily tell you the whole story, because it also includes SMEs, by the way, as well. So it's a bit weird. But that's what the
well, and that one doesn't include interest rates, obviously, as well. That's
correct.
One thing to say, yes, the debt to income ratio hasn't changed, and interest rates were 2%, but now they're 6.
Yeah, and all the other charts, if you look at CBA's charts, for example, they've got this chart that shows this massive spike up in terms of the proportion of income paying interest, and they're arguing it's going to be higher than it's been for a long, long time.
Now, we're not seeing a lot of defaults, though.
No.
So what's your explanation for that, or where do you think the disconnect is?
Well, one is time. So if you think about what happens when something goes wrong, right? Remember, I'm measuring here cash flow stress, right? What that means is that people have to make decisions about what they spend their money on, right? So what they tend to do is they prioritize paying the mortgage or the rent over other things. So you would expect to see consumer spending dialing back. You would expect people to spend less on other things. So in my surveys, I'm seeing some people not getting medical treatment, not getting drugs that they should be getting because they can't afford it, eating less good food, those sorts of things. So that's the sort of the first level, right? Then what happens is that after about 12, 18, 24 months, if you've got a mortgage, you might try to refinance. And there's a lot of refinancing going on at the moment. The banks have been very generous in those refinancing. So they're extending the term of the mortgages. I've seen 35 and 40-year mortgages in some cases. They're offering people interest only as a way of spreading the pain, and other levers like that. So the banks have been quite accommodative.
Yeah, and I think maybe the word accommodative is better than generous. I think in the end, there's not a lot of, you're still paying the same. Yeah, it's just whether you're spreading the pain out over longer.
Yeah, you're going to be paying a lot more interest over the medium term, but you're being able to pay a little less in the short term. Interest only, of course, also it's another lever. And of course, a few years ago, APRA was pressing down on interest only and saying, we should be much more cautious about the use of interest only. But actually, interest only is now back in town. So some of those people who are in difficulty are now actually basically getting interest only as a way to get out. Now, that might be okay for the short term, but in the long term, it does go wrong. And by the way, if you look at the US, the default spike in the US post the global financial crisis, we had those adjustable rate loans, right? The peak in defaults didn't happen until 2.5 to 3 years after the rates went up. There's a lag. Yeah. So I would argue that, and in fact, the latest data that we're seeing is showing a bit of a peak in defaults. Not dramatic, but it's up slightly. But it's a lagged effect. People do other things, many other things, because the point is, if you have a mortgage in a house and you decide to sell, where are you going to go? Because you can't go into the rental sector, right? Because you've got no choice. I mean, there's no rent. So you will do almost everything you possibly can to try and hang on to that property for as long as you can, right? And that's the stage that I think we're in at the moment.
Yes.
Now, this chart here gives you the breakdown by state. And it's a little bit complicated, but I'll focus on the percentages because they will actually give you a better read, right? So the yellow percentages are where the stress levels are higher than last month. The blue is where it's dropped a bit. And it's really interesting that if you look at mortgage stress, which is 49.62%, dropped very slightly this last month compared with last month. But actually within that, only New South Wales and Victoria had a slight drop back. And the reason for that was because of this refinancing lark that's going on. A lot of the refinancing is in these two states. And so people got a little bit of headroom because of that. But the mortgage stress in the ACT, the Northern Territory, Queensland, South Australia, Tasmania and Western Australia rose relative to last month. And in fact, Tasmania is the worst at 64.61% of borrowing households. This is borrowing households only we're talking about here. Now, in absolute terms, there's 220,000 households in Tasmania, so it's not a big number, but it's percentage quite a significant number, right? So that's why I always talk about where are the big numbers rather than actually, the total. And if you look at the mortgage stress numbers, the biggest numbers, surprise, surprise, New South Wales, 529,000, Victoria, 533,000, and then Queensland, 348,000, Western Australia, 250,000, and smaller numbers elsewhere. So that's the story there, right? If you look at rental stress, then you can see that rental stress is sitting pretty high at 70%, as we said. Victoria has the high rental stress along with New South Wales. And again, maybe that's not too surprising. Queensland's quite high at 67,000 and Western Australia at 65,000. The ACT is also quite high. And it's interesting, the ACT has a more controlled rental market, as you may be aware, meaning that there are some caps on how much rents can be put up in the ACT. But rental stress is 75 and sitting about that level this last month. Then you've got some stressed investors. Go on.
My guess would have been there's a reasonable amount of, reasonable amount of the renters are students in the ACT, I would have thought as well.
Yeah, there are some students there, but there was also quite a few people who dropped out of the housing market and have got no choice but to rent as well. And there's been quite a large amount of unit construction in and around the ACT over the last few years. Quite a lot of it's poor quality, and quite a lot of that is actually rented out to what I call the lower socioeconomic areas that are actually still in and around the ACT. Interestingly, of course, in the ACT, the average incomes are quite a lot higher relative to everywhere else because of the very strong concentration of public servants.
Yeah.
And then the financial stress, the financial stress is the aggregate of mortgage, rental, investor stress, and it takes all households rather than actually the mortgage, rental, or stressed in households. And you can see there that it's 48, 49%. So we're sitting around half of households, but it's higher in New South Wales. So New South Wales has the highest proportion of those in financial stress.
And in terms of stressed investors, are they? I'm guessing some of those are going to be part of the same group, the other group as well. They'll also be stressed mortgages or stressed rental.
Good point. Right? So, and we'll look at that when we look at some of the segments. You'll see that there's some quite interesting footprints there. But yes, absolutely, you could be in more than one category if you've got an investment property as well as a mortgage property. And one of the things we are seeing is some property investors now selling one of their properties to try and solve the problem. And quite a few people have multiple investment properties, 2, 3, 4, 6, 10, 15, 20. And so they're selling one of those properties. And that's why listings are up a little bit. And it's quite a lot of old, low quality investment property that actually is difficult now to let higher. And of course, there's also new rules that have come in with things like smoke alarms and other requirements in some states to improve the quality of the investment stock. And some investors don't want to or can't afford to do the necessary repairs.
Yes. Okay.
If I then go on to the cohort story, so this is now where we get really into the meat of the discussion, right? Because in my cohorts, I go across from young growing families at the bottom. Those are where a lot of the first time buyers are located. The young affluents, so those are people who are without families, younger but very well paid. Then we've got wealthy seniors, so those are people with their own superannuations. Stressed seniors are people who are on the state pension. And we've got then suburban, the mainstream, those in the rural areas. The multicultural establishment, which are the first generation Australians, so they're the people who've migrated recently. The mature stable families, so they're the older, maybe their kids have left home or about to leave home. The exclusive professionals, which are the most wealthy in the place with bigger incomes and maybe more property portfolios. And then you've got what I call the disadvantaged fringe and the battling urban. So those are the ones on the edges of our town, with the disadvantaged fringe right on the edge and the battling urban a little closer in. So that's the sort of the segments we use. And we use the surveys to put people into these different segments. Now, you can immediately see that the distribution is quite interesting. You've got a lot of disadvantaged fringe, 1.6 million, right? You've got a lot of suburban mainstream. They're the two biggest. But then you've got quite a lot of young affluents and quite a lot of young growing families, so 719,000 young growing families. So they're where all the first time buyers are. Then if you go across to the percentages, so the highest percentage are actually the young growing families. That's where a lot of the first time buyers are, a lot of people who bought in the last 2 or 3 years, a lot of the ex-home builder, etc., etc. So 90% of them are now in difficulty. That's about 302,000. Okay.
Yes, and that's a lot of people who have to, isn't it? It's always the
you always stretch yourself when you first buy a property. You always expect to be in difficulty, but when you had a 2% mortgage and you now got a 6% mortgage, gee, that hurts, right? So that's where
well, and it's that. It's one of those arguments for property. An ongoing property tax rather than stamp duty that sort of makes a lot of sense. Is saying, well, if you've got these taxes, property taxes that are paying for hospitals and schools and nurses and all that type of stuff like that, is basically you're saying, okay, if you're old and you don't need to move and you're financially well set up, then just take it easy. You don't have to pay. Whereas the person who's just had another kid or 2 kids and all of a sudden has to buy another house, we're going to force them to pay the taxes for you. And in a way, I guess that's the similar thing for here, isn't it? In that, if you've just had 3 kids over the course of the last 3 or 4 years, then you have to buy a bigger house. There's no, and then that's
not much you can do about it. I'd make the point about the stamp duty. All the evidence is if you remove the stamp duty, you put the price up by the amount of the save that you make. So it doesn't actually net necessarily work, right? It just spreads the pain differently. So I'm a little skeptical of that as a so-called lever.
No, I'm not saying that's going to get your prices down. Equity of who's paying the tax.
Correct. No, exactly. That is the point. Exactly. Now, the battling urban. So those are the people, again, quite often bought recently or a little further back in time, but these new estates. So they're sitting in these new estates, high density houses and some apartments, but a lot of these large estates on the outskirts of town with much diminished infrastructure and quite often with big mortgages because when you buy new, particularly off the plan, you end up paying quite top dollar, and then what happens is the next suburb then starts being developed and you suddenly find that your place isn't as valuable as it was because it's not new anymore, and so you get caught in this loop. So there's a lot of those. Right?
Now, just in a big picture sense, so you've got about 11 odd categories here, I think, is it?
Correct.
Yep. And then, and these, we're looking at households, so 10 million households ish in Australia. Is
correct.
That's roughly where we're going. 10 million households. Yeah.
Correct.
So okay.
Yeah.
So in terms of people wise, you're multiplying these by 2.5. Well, there's probably a little bit different in that maybe young growing families is even bigger.
The mix is different. The mix is different by cohort. And by the way, I have been upping these numbers with the migration. So the migration numbers are strong. So I do actually sensitize it for migration, and I've got some data on where the migrants are more likely to go and what they're. Well, that's partly census driven and a few other things. So the numbers are getting bigger, which is one of the reasons why property prices may not fall as much as some people think.
Yeah, but as I said, it's when you look through the mortgage stress, for example, it really is focused on those two particular categories.
Absolutely right. Yeah, just in pure
numbers.
Whereas
rental stress is a bit more democratic.
Well,
rural families.
So let's look at rental stress. The peak, and again, the yellow here is peak rather. Top numbers rather than actually movements from last month. I should have said. Multicultural establishment. Yep. So this is the first generation Australians, right? 81% of them have a rental stress problem. I think that's very significant. So people have come into Australia and looking for somewhere to live, they're having to pay a lot for it, and then they're struggling to make the payments. So that's a significant factor, right?
Yeah.
Then you've got the young affluents. So a lot of young affluents who want to live close into town, want all the benefits of living close to the CBD, and are paying a lot of money for it. So quite a few of them now are struggling. And then you've got young growing families, again, no surprise, same issues, but they're renting rather than actually owning a property. So they're the ones that are right at the top. And then it's, as you say, more democratic, pretty much across the space. Interestingly, rural families are less stressed, relatively speaking, but still 38%. But it's quite a small number because it's a relatively small area. And if you look at the, sorry, I'm looking at 105,000. Sorry, I missed my line there. And if you look across here in terms of where the big numbers are, a lot on the disadvantaged fringe, some more stable families that are struggling there, the multicultural establishment, 191,000, but also suburban mainstream. So even those in middle Australia are also now being caught, as well as young affluents and the young growing families. So as you say, more democratic. The common factor is they're in the rental sector. From the investment perspective, what's interesting there, of course, it's partly a question of who holds investment property. A lot of exclusive professionals hold much of the investment property, and about 36% of them are exposed to problems with those investment properties. But the one that takes the prize are young affluents who've got investment properties and don't frankly know what they're doing. So they've been sucked into this idea that, property investment's great, you get all the tax breaks, etc., etc. So they've piled in. And unfortunately, quite often when they've piled in, they've ended up with a a pretty bad proposition. So that's why it's 42.66%. And
and as well, they're going to be pre just by being younger, they're going to be they're not the people who bought 10 years ago or 20 years ago. They're the people who bought
they
in the
bought
last
more
5
recently
years.
with higher mortgages, bigger mortgages, and now those rates have gone up. So they're being caught also with the costs, and particularly the thing I'm noticing are strata costs. The strata costs are massively increasing because, of course, the cost of everything's gone up. And interestingly, if you look at the bankruptcy statistics, there are more people now being made bankrupt because of failure to pay the strata costs than ever before.
Oh, really?
Yeah. And the second one is that strata companies are able to declare a problem at relatively small amounts outstanding, so they tend to go down that route quite quickly.
Right.
Right.
Well, so when you say relatively small amounts, so we're talking what, 5,000, 10,000?
10,000.
Right.
Yeah. So strata companies are a bit prone to pulling that lever. All right.
Yeah.
So that's a factor that a lot of people never thought about. How much are my strata costs going to go up, and how much more will they go up ahead?
Yes. Well, that's right, and especially from the point of view of like, I own my own place now. I don't have to worry about rent anymore as well. Some of the strata fees are, especially if you're in close and you have pools and gyms and all that type of stuff like that, can be not that different to renting.
And the other factor is a number of new properties were poorly built, and so they've actually got surprising amounts of repairs coming through that they weren't expecting and weren't budgeting for. So unfortunately, recent property is not immune to this. And in fact, some of the lower strata fees are actually in properties 30, 40, 50 years old, which is older property, but it was better built to start with. So
well, and there's some of those cladding issues can, I've seen ones where they're 100,000 plus per apartment to fix the cladding, because it's not up to fire standards.
Yeah,
so, yes.
Exactly. It's a big deal. And then just quickly on the overall financial stress, you can see there that the young growing families and the battling urban are right at the top of the list. But you can see there that multicultural establishments and some of the others are sitting there as well. So the overall financial stress levels are quite high. But again, it's worth just underscoring, right? Not all households are in that bucket, right? Because there are still a lot of households that, as we said earlier on, are doing absolutely fine, right?
Yeah.
But it is still a worryingly high number, and it's growing. Now, another way of looking at this is then to look at the top postcodes. Now, I'm just quickly going to go through a few just to give you a flavour, but the mortgage stress count is what I'm sorted by here. And the postcode across the country with the highest mortgage stress count at the moment is actually Liverpool South, Warwick Farm, Chipping Norton, that area. Liverpool being the centre of gravity, right? And then you've got Campbelltown.
And for people who are unfamiliar with Sydney, that's sort of outer southwestern suburbs.
Outer southwestern Sydney, high growth suburbs, a lot of relatively recent construction, a lot of poor quality construction. Again, a lot of infrastructure missing. Right, so they're the top two. The third one is actually around Toowoomba, and includes some of the suburbs around Toowoomba. I should say that these location labels are the ones that the ATO uses. Sometimes they pick a funny one, so it's really Toowoomba, but it's called Harristown, so it's just a weird one. But that's 12,000. And then you've got Western Australian postcode 6065, Tapping, and places like that. And then you've got Roxburgh Park in Victoria. You'll know some of these areas being a Melbourneite, Narra Warren. And so, high growth areas, Fountain Gate, places like that. And then you got Camden, Oakdale, the Oaks in New South Wales, back to Pakenham, and then back to Berwick and Harkaway and Cranbourne.
Yeah, but I think that I would say that the rough looking at those, most of them is outer urban.
Yep.
New developments, and you'd probably say a relatively high amount of immigration relative to other suburbs.
So battling urban, disadvantaged fringe, first-time buyers, and of course some of those people who've first-generation Australians. And then we've got Ballarat, for example, in the regions, and then back to Box Hill and Marsden Park. That's another high growth area of vineyards in New South Wales, and then up to Queensland. So that gives you a flavour for the mortgage stress one, right? And then if we do the same for the rental stress, centre of Melbourne actually takes first prize. 15,400 renters in the centre of Melbourne, postcode 3000, are struggling, right? It's right at the top. And then we've got Liverpool again, then we've got Toowoomba again, then we go to Westmead and Wentworthville, and then Zetland and Waterloo in New South Wales, and then Hoppers Crossing and Tarneit in Victoria, and then Campbelltown, and then Coomera, Southport, that's sort of in the Gold Coast area, Cranbourne, Mount Druitt, one of the old favourites.
Yeah, I mean, what's interesting from this list is that so most of the same ones as you said. So it's the part to say, So you've got a particular demographic, say let's pick Liverpool because that seems to it's appeared very high in both of them.
Yes.
It's saying, so the people that live in that suburb can't afford to rent there, and they can't afford to buy there either. So
that's the problem. And what I posed you the point earlier on. If you've got a property there and you're trying to make the mortgage payment, right? What do you do? Because you can't get a rental property, right? That's the dilemma that people are now facing. Like I said, they're caught in the headlights. What do? Do I struggle on? Do I not struggle on? That's the real difficulty. And interestingly, if you talk to some of the banks on their hardship schemes, quite a lot of the hardship requests are coming from these very areas. And if you talk to the debt advisory services, they're again saying these are the hotspots. These are the areas where they've got huge numbers, right? And remember, I'm looking here at numbers because I do believe these big numbers are very important. So it's the outer suburbs, right? Plus, if you go down the list, you've got Parramatta, and then you've got Point Cook and Derrimont, Victoria, Ipswich. Of course, that's to the west of Brisbane. A lot of growth that's gone on there recently, and so it goes on. Blacktown, Fortitude Valley. If we then move on to the mapping, now this is mortgage stress, right? And what's interesting about this, it sort of really brings it home, right? This is Melbourne mortgage stress, and you can see immediately, the coding goes blue is fine, it's low, and the counts go right up to 8,000, 9,000, right? And you can see here north towards the west, and then down towards the east as well, right? Beyond Dandenong and all those areas we spoke about before. So you can see there's some real hotspots, right? And so I find this geomapping a very powerful way of showing what's actually going on the ground, because it's not uniform across the place. And in fact, I've got tools that allow me to drill into postcodes in more detail and really look in a lot of detail at what's going on. But you can see the problem there. And if you go then to, we'll just go to Sydney as well. But this is my ring of fire, which I call ring of fire around the western suburbs, right? From Blacktown in the north, round through some of the Liverpool and Camden areas, round to Campbelltown in the south. All that western suburbs, right? That's where a lot of the pain is. Now, again, if you drill in, there are a few postcodes, like, for example, Bondi, where they've got issues closer in, and even Mossman, there's a bit of hotspot, but nothing like this. This is where the big numbers are. And so when you see the default rises that I expect to see, I believe that there will be in these ring of fire postcodes. And it's also, interestingly, that if you overlay building failures, the building failures are also concentrated in these same hotspot areas. So we've got a lot of half-built properties where building construction companies have gone bad and people haven't been able to get the properties that they were expecting. And so we also have a lot of people who've contracted to move in and buy a property who haven't been successful. So that's why this is important to understand. These are where the hotspots are. This is where some of the social consequences will play out. And that can be everything from shoplifting through to higher crime rates and other things too. So it's a real social problem, but again, it's not uniform across the whole place, right? There are other areas where people are still living in fine properties and earning good money, and they're spending like there's no tomorrow. Other areas, it's a real problem. And I think this polarization that I'm seeing with this chart between those in the western suburbs and those perhaps in the eastern suburbs really is an archetypal problem for us.
And because this is the, there's two takes on, do we go through this classic cycle where you get a particular part, rising interest rates puts a damper on everyone. We've also got all the other rising rental costs and things like that, and that sort of means that we start to go into this unemployment cycle, and as the unemployment cycle picks up, people start having to sell the properties, and then that sort of gives you the next leg down, that and you go through your unemployment spikes, and then eventually we settle and we start a new economic cycle. There's a thought behind some of this is actually, well, if the banks though are going to try and very much sort of let people just work this out, and you still do have a big portion, as you said, that's spending like there's no tomorrow, does this end up just being as like an issue within certain cohorts where we're basically, look, we've got a third of the population who's incredibly stressed, can't find places to rent, can't get mortgages, can't get on the property ladder, and are stuck in low paying jobs, but actually the rest of the economy will just carry them through, and so maybe there's no light at the end of the tunnel for them for years and years and years, but there's not it's a long and chronic problem as opposed to a typical cycle.
Yeah.
What are your thoughts on that?
I agree that it's unique this time. There's three factors why it's unique. The first is very, very high migration. So you're feeding the engine all the time. You've got more people coming in. I think you'd have to build 300,000 houses each year, or places to live, to sort of meet the demand from migrants coming in. We're not doing anything close to that. So there's a supply problem already, which is going to actually mean that there's going to be some support for some areas and some markets. The second is that a lot of people who hold property are so desperate to keep holding the property, they'll do almost anything to keep holding the property. So we are seeing significant uses of buy now, pay later and payday loans. We're seeing people, have garage sales to be able to actually...
That's not fixing any problems, though.
No, I know it's not, but it will keep the ball in the air a little longer, right? And when you talk to people, as I do in the surveys, they're hanging on to this thought: rates are going to come down again. In a few months it'll be better because rates are going to come down again, right? And of course the estate agents have been saying precisely the same thing. We've reached peak rates, it's going to get better soon. And I am worried that they are being misled by that mantra, because, as I said earlier on, I think there are some indications that inflation will be higher for longer, and that means that the RBA may have to hold rates where they are or even lift them through 24, 25.
Well, yeah, and that's the one we've spoken about multiple times as well, is that when you've got energy costs that aren't really affected by interest rates, when you've got housing, which is arguably, especially when you have supply problems, arguably made worse by rising interest rates because it's harder for people to build, is that if they're your big costs, then you end up with this problem that you're using the brake and the accelerator at the same time. So, yeah.
Exactly, as I think Tart Brooker calls it, it's the burnout economy, because you're going to burn your brakes out, or you're going to do something pretty painful. But you've still got people who are enjoying the 35% uplift in their equity that happened post-COVID. All right. So the wealth effect is still sitting there in other parts of the place, right? And as I said earlier on, they're still getting quite good pay rises, and they're not seeing any of the pain. So you've got this huge divergence between those who are really caught on the horns of a dilemma as to what to do with rising interest rates and rents, and those who actually don't think there's a problem, which means that, politically, that's an interesting challenge for the government, I guess, in how they deal with it. But also, when you talk to people, quite often they say it's not me that's the problem, but it's my friend down the road, or it's somebody I know. It's always somebody else's problem rather than their own. Now, some of that could be because in some cases households don't actually know what their cash flow really is, so they prefer not to look, or they just don't have the tools to do it. Only about half of households have a cash flow. And again, when I talk to the debt counsellors, they say the first thing to do is to sit down and make sure you understand what all your obligations are, where the money's coming and where it's going, and then you can make some decisions. But quite often people ignore it and put their head in the sand. And I come back to this point. If you believe that interest rates are actually going to drop relatively quickly, it's a matter of hanging on by your fingernails and hoping you can get through.
Yeah.
But all of this tells me that this is going to be a long grind rather than a big peak and then a sort of a correction that comes back. I don't think we're in that. I think this could be a 3 to 5 year problem. And I also make the point that we've got somewhat similar trends in other countries, like in New Zealand and in the US and in the UK. In fact, in the UK, the data has come out showing, again, defaults are now rising quite fast, but they lagged and then they're starting to rise. So I think my sense is that this is actually going to be a story that will play out not immediately in the short term, but over the long term. And that's why I'm saying I'm not surprised that defaults are so low. They'll stay low for quite some time, but ultimately will go higher. There is more evidence of properties being listed. So the listings are up quite strongly from where they were, although they're still low on a long-term trend basis. But if you look at the type of property that's actually coming on the market, a lot of it's relatively low-quality property. And any property that's really good, high quality is still being snapped up because there are still people with lots of money who can go and buy property. And we're also seeing some investors basically bottom feeding. So when you've got a stressed investor trying to sell, there's somebody comes on and say, well, maybe I'll make you a low ball offer, and in some cases they're accepting it now. So there's a lot of instability in the market. But again, it's not uniform across the place. Depends on where you look and what type of property you look at.
Yeah. Excellent. Well, that's actually probably not a bad place to finish it, unless you've got anything else you wanted to.
Well, I thought I would just briefly touch on scenarios. What's going to happen ahead, right? Because it's worth just thinking about that. And so I have my sort of 3 scenarios. Now, this is just a way of facilitating debate. I'm not making predictions, right? But it seems to me that there are 3 scenarios. Right. The first is that we grind along with the current rates, 4.1 or thereabout, and we pretty much stay there. But rates don't go much a lot higher. There's another one that says, well, actually rates will have to go a little bit higher because of the problem with inflation reasserting itself. And if it does, then what that means is that we might end up with higher interest rates for longer. That puts more pressure on households. We may not get a recession in Australia, but the third one is we get those higher rates and we get a recession, and maybe China is part of that too. So, you can run those 3 scenarios, and I'll show you how it plays out. This is just an example. This is actually Wollongong 2500. And I want to just show you how all the data comes together to get a really granular view, right? So if you look at this particular postcode, 18,900 households, 26% own outright, 25% are borrowing, 48% are renting. So it's definitely a rental hotspot. 26% have mortgage stress of those borrowing with a mortgage. 73% are in rental stress. And there's some stressed investor stuff. Just over half of households are in financial stress. And if you look at the mix of property, it's 35% houses, 52% units, some others there too. Vacancy rate's 9.8%, according to the census. Gross investment yield, 3.4%. Net investment yield underwater, minus 0.2. The average taxable income from the ATO was 79,000. The census says 84,000. Bung that into the model, we get a disposable monthly income of just over $5,620. And 43.9% of that is going on the average mortgage at $2,467. And 35% is going on the average rent. So you can see there that those are big numbers, right? And so that tells me that in this postcode, we have an issue. And if I put all that information together, my scenarios are that even in the best case scenario, prices are going to go sideways or down slightly. This is a cumulative view, so maybe down 5% over 3 years. Best case scenario, units slightly less. I have this for more than 2,000 postcodes in the country. And I can tell you there are big differences in individual postcodes when you put all this information together. So this is why this is so important, right? This is why it's important to understand at a granular level how things are actually playing out.
Yes. Yeah, excellent. And so in terms of the scenarios, so sorry, and actually it's probably this cliff part. The next question, one of the things that sort of occurs to me is, okay, so I've just been reset from 2% to 6%, whatever, and there's, you know, and I'm looking at the fees. I'm looking at the extra amount, and as you said, just hoping to hold on and wait for these rates to fall again. What do you think the time frame? How long do you think it is before that they're actually in genuine? So in terms of a cash flow part, as I said, we built up these extra cash flows. You know, I guess it's that part about, okay, I've had a problem. It's not the first month. You know, I've probably got enough to get me through the first month and maybe the first few, and then I start to run into problems. I can't afford it. You know, I stop paying my startup fees or whatever. As you said, you stop eating out. You go through those parts. It would seem to me that you would be, I don't know, 9 months to 12 months, you'd think, before people are actually in a position that, okay, now I've actually genuinely got to sell because I've just racked up too much debts and I've used my buy now, pay later, and I've maxed out my credit cards and it's just too late. Is that sort of a rough time frame? Or
remember what I said about the global financial crisis in the US? It was 2.5 to 3 years later before defaults hit a peak.
Yeah.
Right? It's an object lesson to say it's going to take some time. What happens generally is that people will struggle on for a few months thinking, well, maybe things will get better. And then they will try and do a refinance or a restructure, which will give them an extra run at it. And by the way, some of the banks are allowing people to draw out equity from the property to cover the payments for 6 to 12 months. You know, the banks don't want to actually start putting higher levels of delinquency in their books. Well, one of the ways to do that is to allow people to draw equity out and then just keep the ball in the air a bit longer. So this could be a couple of years. This could be 18 months to 2 years before we really start seeing the full impact. The other question is, what happens to unemployment, right? Unemployment's still very low at the moment. Will it stay low or will it start to rise? Because if unemployment starts to rise, that's the killer move, right?
Yeah.
Because while you're still in the job, you can probably struggle on. But if you suddenly find that you've lost your job, then that's a big issue. That's why this question of is there going to be a recession, if there's going to be, you know, and the RBA, or the new RBA governor, gave a speech some time ago saying it's got a 4 in front of it, unemployment, 4 point something, right? So that's the other factor. Final question is, how long will the banks be able to go on supporting people? At what point does the costs of the funding, and the international funding costs are all over the place because of where the yields are, how do they play into that? At what point do the banks dial back their mortgage lending because they can't afford to do it anymore? And so that's the other thing I'm sort of thinking about.
Well, and it would seem to be as well that's a little bit of a, there could be a rush for the exits at some point. Like while all the banks are saying, no, we'll keep extending you and we'll keep letting you draw down and go to interest only and go to 40-year mortgages and all that type of stuff, then actually that's a good thing for all banks. Because, but if one major bank decides, actually, no, I'm going to start pulling the pin on these things, and I've got to get my customers out, then, then everyone suddenly says, actually, well, if you guys are doing it, I'm going to do it as well. So
there's a certain lemming attitude amongst banks, right? Where one goes, everybody else follows, and so you're absolutely right. Everybody at the moment is following the same path of trying to help people and doing all those things, right? They have reduced some of their lending criteria. And, just quickly, the borrowing power of the average new applicant now is 40% down from where it was before they started, right? Which means that you cannot get the same mortgage that you got 2 years ago. One reason why I don't believe that property prices can go on going up. They are going to have to actually go sideways or down because it's all about credit supply and credit availability. The banks are not lending so freely. The banks are now more worried about trying to support people who already got mortgages with them and they're trying to find a way through. that's not necessarily that profitable, by the way, for them. So I think profitability and margin compression and all those things are going to be there for people to see. And I am conscious of this bond problem with the high cost of bonds. That is a signal of funding costs to the banks are going to be more expensive. So again, profitability to the banks are, I think, in question. So at what point will they turn turtle?
Yeah. Yeah, well, and there's that you had that your rental stress line was as you said, it's going pretty vertical there. It's but it only goes to 100, I'm assuming.
Well, you would assume.
Don't go past 100%.
No, by definition. And look, maybe people will go on, prioritizing the rent over other things and giving up on eating out and giving up on those expensive mobile phone plans and multiple streaming services. I mean, there are things that people can do. I'm fascinated by how few people understand their finances well. And sometimes when they do, they can make better prioritizing decisions, right? And, there are spreadsheets and things that people can use to do that, or other tools. But I'll leave you with this thought, right? What's the marginal impact on the economy, right? Is this going to be sufficient to slow retail immediately because people don't have the money? Or are there enough people still with lots of money to be able to continue the retail cycle so that the retail sector continues to bubble forward? Now, Roy Morgan published research last week suggesting retail's on the slide and will continue to slide, right? We also know that household confidence is ultimately very low. It's low as it was through the global financial crisis, and et cetera, right? In fact, I think it's now the level that we had through COVID briefly, but it's now in that area quite permanently. So people are not confident. So you've got the confidence question, you've got the finance question, which we've touched on, and then you've got the broader economic question. And the question is, are the government strategies, are they pulling any levers that could actually provide a lifeline? And things like the housing strategy and the housing investment schemes, well, we're not going to touch the side. That's not going to help particularly at all. So I don't see much in the way of government reaction to the true state of play amongst many households at the moment. So a lot of households are on their own, which comes us to lead to the conclusion that's why a lot of people are caught in the headlights and are not sure what to do.
Excellent. Now, do you want to give a quick recap of where people can find more of your stuff?
Yeah, well, thank you very much. Yes, so Digital Finance Analytics is my blog. It's digitalfinanceanalytics.com. And I'm also on Walk the World on YouTube, and I make daily shows. And in fact, I ran a live stream on Tuesday of this week when I went through this in a lot more detail and went through a lot of individual postcodes. If people want information about a particular postcode, they can contact me direct via the blog, again at digitalfinanceanalytics.com, and I'm happy to share the one page. Gives a bit of a flavor. You can also, if you want to, you can subscribe via my Patreon programs to get the whole data set, and some people do that. So, but I'll continue to make this data available because I think this is a really, really important conversation, because it gets away from this aggregate view of everything, right? You've got to go granular. You've got to understand that there are differences out there, different cohorts, different stories, and hopefully my data helps to tell that story.
Excellent. Thanks a lot, Martin. Appreciate the coming on again.
Yeah, great to talk. See you later. Bye-bye.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. So that wraps us up for today. So from myself, Martin, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time.